Welcome to Resilience and Resolve with Lance Drury.
Hey everyone, welcome into an all-new episode of Resilience and Resolve with attorney Lance Drury. I am your host, Mike Leon. For more than 30 years, Lance has been helping individuals and small business owners regain control when the IRS problems sometimes feel overwhelming. Today's episode, we're talking about a challenge that affects a lot of business owners and self-employed individuals out there, and that's resolving that tax debt when income isn't steady from month to month. I know a little bit about this myself, Lance, so I got some questions. But when earnings rise and fall, dealing with the IRS requires a different kind of planning, and Lance is going to explain all that in just a sec. Lance, it's good to see you as always, my friend. So let me ask you, how does irregular or seasonal income kind of change the way the IRS views someone's ability to resolve that said tax debt?
Well, it doesn't really change it. You still have to prove you don't have the ability to pay it all back. But here's the deal: 70% or more of my clients are self employed. Those are the people that get in trouble because the taxes aren't automatically taken out. And a lot of those people, their work is seasonal, or, they don't bring in the same amount of revenue every month. I don't bring in the same amount of revenue every month because I'm self employed. So here's what you do. You don't, when you're seasonal, you get to submit. You got to start and go backwards. But, unless they ask otherwise, you can go back 3 months, 6 months, 9 months. So we do all three. And we say which of those time frames that you can pay the least amount back to the IRS. And obviously, let's say you're into, I guess, landscaping or whatever. You don't have a whole lot of work in the winter, I wouldn't think. And so your winter months are going to be slower. So you obviously want to include those, because if you don't, you're showing income which is higher than it should be. So obviously you want to go back far enough to include that in there so that you can get a better deal out of Uncle Sam. So, for a lot of self employed people, you may want to go back as much as a year, and the IRS might request that. They might request, particularly if it's a revenue officer, that instead of giving them 3 to 6 months tax returns to look at, they'll look at a whole year of tax returns just because of the seasonality of the business. And then even if you're self employed, certain things can cause you to have all these fluctuations in your income. Mike, last summer, I had record revenue months in June and August because the IRS was coming after people. Highly unusual, because normally in the summer, people don't worry about their tax problems because they want to go out and have fun in the sun. Well, guess what? November and December, we lost money, a lot of money, because of the government shutdown. And they came back in mid-November, but, they just don't come back the next day and things are back to normal. It takes them a while to issue levies and all of that. So, even in my business, certain outside events are going to affect that. And that's the same true in bad economic times. For restaurants, times inflation gets bad, revenue is going to be down. So, when you have your own business, you got to look at a bigger time frame when you determine what's a more accurate income for the business.
Lance, let me go back to that gardener example, and you can expand on it as well. But what in that scenario, what tends to happen when people try to commit to maybe fixed payment arrangements, but it doesn't actually reflect, like you said, how the income actually comes in?
Well, what's going to happen is they're going to have a bigger installment agreement than they can handle because they don't have the discipline to set money aside during the high months. Or even if they do have the discipline, it's not going to be enough because they over computed their income. And then what's going to happen is they're going to default on the agreement when those bad months come in because they're not bringing in enough money to pay on the installment agreement. So what you need to do is to set it up so that it's for like a year. And so you get an average of a year about what your income is going to be. And then you have to have the discipline to set aside that money so that when the bad months come, you can still pay that monthly payment. Now, here's the other thing. I had a guy once, I got him set up on a $50 a month payment. I was through with him. We got it set up. He wasn't going to pay the vast amount of his payments, and we had told him, but he didn't listen. He sent in a $150 payment, thinking, well, that's my payment for the next 3 months. No, it's not. That's not how their systems work. It's a minimum. The $50 was a minimum monthly payment. Even if you pay $150, guess what? You still owe $50 the next month. So they defaulted him on the agreement because that's how their systems are set up. They're not set up to spread that $150 over 3 months. So then again, he had to hire me to renegotiate his settlement because he had to.
Discipline. How about another D word, Lance? Document. How important is it to document the income patterns when you're working through these resolution options?
Oh, it's extremely important. Number one, and everybody knows this, but some people think, oh, I get cash, I'm not going to report it. Guess what? That's a crime. You're falsifying your financial information statement. So you need to track your cash. If you take some monies from your personal bank account, put it in the business bank account, you better document it because they're going to assume that's business income until you prove otherwise. And then all your expenses. So you've got to have documentation for all your business expenses or the IRS isn't going to give it to you. And do not, if you have a business, and most people don't do this who are sole proprietors, it's a huge mistake. You need a separate bank account for the business. Make sure that only business income goes into that business account and make sure you're only paying business expenses from that bank account. You got to segregate your personal from your business or they're not going to know. You're not going to know. If you set up a separate bank account, you can see what your starting balance is for the month. You can see your ending balance. And then it's quite easy to see how much money you made for the month. But if you got all these personal expenses or personal income in there, you have no idea how much money the business made for the month. So that's one of the best pieces of advice I can give to small businesses. And guess what, Mike? A lot of them don't do that. And we have to explain all that to them that from this day going forward, they have got to do that. So they have great books that they have in order to show the IRS or the state taxing authorities.
Yeah. Lance, can you share some, without obviously getting too specific into details, but share a situation where maybe adjusting the strategy on the client side to kind of match the cash flow, change the outcome for their case?
Well, I don't know if I know exactly what you're asking, Mike, but yeah, obviously it's always a cash flow analysis with the IRS. For example, if you file a profit and loss statement, they're going to take the depreciation out because that's a non-cash deduction. So everything is a cash flow. So you've got to keep everything on a cash flow basis because that's what the IRS looks at when they look at your reasonable collection potential, RCP. That's what they're doing when they look at your income and your expenses and the equity in your assets. That's what they're trying to determine. It's a snapshot. They're not going to go back 2 years ago. They don't care what you made 2 years ago. It's what you're doing currently, and they're not going to guess at what you're going to have 2 years from now. For example, you can't call them up and say, oh, I'm going to retire in 6 months, base it off that. No, they're going to say, you set up an agreement now, and then in 6 months, if you retire then, because they don't know if you're going to retire, you call us back and we'll renegotiate the settlement. They're not going to take your word for it. So it's always a photograph of your current financial situation, and cash flow is really important. And you've got to get that down right because otherwise you may be paying more monies to the IRS than you should.
Lance, we've talked about payment arrangements, but are there other resolution options that are maybe more realistic for people whose income is unpredictable, like we mentioned, or predictable?
Well, you can do an offer in compromise, but they take into consideration your equity and assets. So a lot of people that have a lot of equity in their home, they might qualify for a currently non-collectible, but they won't qualify for an offer because they're going to look at the equity in your home for an offer, but not for currently non-collectible. There's also different types of installment agreements. There's more than one way to skin a cat. You can do what's called a partial pay installment agreement. It's like an offer in compromise in that you're never going to pay back the full amount, but it's also like an installment agreement in that you're going to make those payments monthly. Because guess what, Mike? The IRS does not have forever to collect the tax. And then in limited circumstances, you can look at bankruptcy, not for payroll taxes, not for trust fund taxes, but you can for income taxes if they're more than 3 years old and you qualify with some other criteria. But that might get rid of some of the tax liability, but not all of it. So, we look at those options too, and we see if the clients are in fact eligible for bankruptcy when we get their initial information and go through the chronology of their case with all the records that we can obtain from the IRS in order to do an analysis of their case.
Yeah. Lance, we mentioned about the bank accounts and not splitting off business and personal, but what other mistakes have you seen people make that have this irregular income and it causes the IRS to kind of come in?
Well, they ignore the IRS. They don't respond to the notices. They just don't do anything. And sometimes they claim they never got them, and most of the time they're wrong about that. Or the other thing is people think they can do this on their own. They get a revenue officer. And the revenue officer wants all kinds of stuff from the taxpayer. It's confusing. It's complicated to the average individual. And then they get levied. And they come down and talk to me and they go, I sent everything in. And then we check it out. No, they didn't send everything in. Like I said, it's confusing. It's complicated. They don't make it easy. And in that 9297, which is the summary of taxpayer contact in which they ask for all this information, it says, if you don't give us all the information, one of the things we can do is levy you. And unlike us, when we get involved, they won't call the taxpayer. They'll just levy them. They won't give them any notice and say, hey, you didn't give me this, this, and this. But with us, we always say, if there's something missing, give us a call. We always get it in writing because when I first started, I didn't do that. And then they'd say, oh, you didn't send me everything. Well, it's not in my notes. So then I started saying, send me everything in writing, and you're entitled to all of that in writing.
Yeah. So Lance, for someone out there that's listening to this right now and they earn income seasonally or unpredictably, like we talked about, and they're also dealing with a tax debt currently, what would you want them to understand before they actually start choosing a resolution path?
Well, one of the things is they've got to make their estimated tax payments. If you don't make your estimated tax payments, because I'm assuming when you talk about seasonality, they're self-employed, you got to be compliant. If not, they're not going to give you an agreement. And then after that, you got to make sure that you get the income information and the expense information spread out over a long period of time, because you don't want to include just the months where you have very little income. You want to include all the months so that you don't overstate your income to the IRS. And then you get an agreement that you can't afford. And this is why you need professional advice. This is why you need to call Lance Drury Law.
This is why you need professional advice. Landing the plane beautifully. Lance, thank you as always for the time, the insights, and breaking this down for the audience. I appreciate it.
Thank you, Mike. Good to see you again.
And thank you to everyone out there for listening to this installment of Resilience and Resolve with Lance Drury. Look, irregular income doesn't make tax resolution impossible, but it does require a strategy that reflects the reality instead of best case assumptions. And if you're dealing with tax debt right now, or you got uneven income, you want some guidance before committing to the wrong solution, like you just heard Lance say, visit lancedrurylaw.com, schedule a consultation with Lance and the team. One more favor before you head out the door: like, subscribe, leave a review, comment, share the episode with someone who needs to hear it. As always, I'm Mike Leon. We'll see everybody next time.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.